Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's the Monday edition of Trader Talk in today's market, and I am your host, Kevin Horner. Thank you all for being here today. We had a lovely weekend in Dallas as we kicked off the market drive this weekend. Wonderful opportunity to see a number of you. I got to shake some hands and take some pictures, and I'm always engaged or enthused rather when I get to see those of you who attend these classes on a frequent basis. It always is a nice way to further the ongoing process of trading and trade management and carrying the conversation everywhere we do. So it was really great to see so many of you there in Dallas this week. Today, we are going to look at how things are shaping up as we kick off the week. We had some pullback in oil this weekend due to President Trump's decision to not attack Iran, it looks like. And so there's been an ongoing battle there at the headlines, at least. We'll see how markets are reacting. We're going to talk about that. Certainly look at the major indices. We're going to peek in on the big boys, the S&P, the NASDAQ 100, the Russell 2000, etc., and see if we can understand some of the recent trend development that's been underway. Today, we have Connie Hill in the chat this morning, so you can say hey to Connie, who will get to comments and questions I'm unable to address with all of you. Make sure, if you're not already doing so, to follow Connie and me on X, Connie Hill CS and Kevin Horner CS. It's a great spot to find us when we're not hosting classes for you here on the channel. Now, with that, let us get to our disclosure so that we can move to the fun stuff, the charts for you, of course. So first and foremost, remember, everything we discuss today should be considered informational and educational. We do not make recommendations nor endorsements for any specific approach to trading the market here. What we do offer, however, are technical analysis, concepts, and strategies traders may choose to employ. We do that from an educational standpoint. What we encourage you to do is learn more about these concepts and strategies, apply them to your process as you deem necessary and appropriate for the way that you like to manage your positions and your trades. None of that, though, should be considered recommendations. Like I mentioned, we're all very different as traders, and our process will differ from one trader to the next. But a lot of these principles can carry for us as we evaluate trends and make decisions on how we're going to manage those individual trades. So, last note, as always, remember to think of technical analysis as one of your decision-making puzzle pieces, but certainly not the entirety of those decision-making puzzle pieces, meaning simply do not make decisions only off what we see in the way of technical analysis. Now, today we do follow that top-down agenda. As I mentioned, we'll look at the biggest indices and work our way through them. We'll definitely touch on the semiconductor chart as well and talk a little bit about the equal weight index of the S&P 500, get a little clarity on leadership there, and see if we are due to get maybe a bounce out of the technology space, which has been lagging for a bit, as we've seen a little bit of a pullback in memory, a pullback a little bit in semiconductors, and we'll talk about some of those sector industry groups rather as well. So with that, let's peek in on the S&P 500 as we'll kick things off. So already a good positive development this morning is a bit of a continuation through the high trade from Friday. So we like that. And, you know, for those of you in Dallas, we talked about the essential consolidation that we're witnessing here. If I draw in that downtrend line, capturing the matching highs we made here in early to mid-July, we are right at the downtrend line. We can also go back, and it doesn't really matter if I drew it from back here or back here, but ultimately, this is kind of what we're seeing, right? Still in consolidation and largely tied to the allocation of this big index. As we know, for those of you who maybe are a little less familiar, we can highlight this with the use of our heat map in the S&P 500, but you'll notice that we have all 11 sectors of the S&P are noted here, but there are some that are much bigger than others, and not just the group that is bigger, but the individual stocks within them that are much bigger. Technology clearly carries a heavy weight as it relates to the S&P 500 cap-weighted viewpoint. And as it relates to communication services, well, we can clearly see that Alphabet carries a lot of weight for communications, as does Meta. And when we look at discretionary, Amazon stands out as the biggest of the bigs in that space. And so when we get moves of epic levels, we get a lot of selling, for example, in technology. The reason that we've been able to maintain that sideways trend in here isn't because technology's holding us up. It's because we're getting leadership from those other areas. And so it's so important to remember to think about the market both individually, sector-wise, groups that you're monitoring, groups that you're trading and watching. But at the same time, we have to make some assertions as to where we could then place our new dollars for investment. So if we went to my symbols on a quote basis, looking at the 20-day change, we see some leadership that differs from what we've seen lately. Discretionary back up in the top three. We've also got financials and staples and real estate in the top three. Energy leading us recently with a nice 7% move. But the point is, this is precisely why we're getting consolidation in the broadest of the index. But if we break this out and look at the equal weight, you'll notice that we've continued that uptrend. So I've got a lot of drawings in this pattern. We've been watching it for a while since we broke out of this beautiful cup and handle to the upside. Right now, it looks like we may have already achieved our so-called measured move, but we're less worried about that than we are just the continuation of the trend. Notice how stout that the 20-period simple moving average has been here, everybody, in orange, with a beautiful test on there Thursday, got below it, and then finished the day with a hammer above the 20-day, more or less validating the 20-day as an approximation of support. We could probably alter that 20-day real quickly and make it a 30-day, and I would venture to guess we would see that the 30-day maybe has been less violated. Yeah, and sure enough, if you wanted to shift, at least as it relates to the equal weighted SP 500 here, everybody, that's notable, isn't it? So 30-day simple moving average offering support along the way here. And again, one reminder, when it comes to picking your moving average, a lot of traders get comfy with the same moving averages and carry those from one investment to another, just utilizing the consistency in their process. And some traders also will make adjustments like we just did to see what is the moving average, which is the prevailing moving average that seems to be offering support or resistance in the trend. And I think, the difference here is the equal weight certainly looks like the tests along the 30 have been just opportunistic, right? And when you change back to the 20, even though each time below the 20 we've bounced, what happens is it changes your confirmation, doesn't it? So if you are the trader working with the 30, well, you've had essentially tests of the 20, but no breaks below it. Pardon me, tests of the 30, but no breaks below it, right? If we change back to the 20, however, those instances now are putting the test to you as the trader to say, well, we're 3-4 days below the 20-day, but we didn't make a lower low. So now should I stay as fully invested as I have been, or is that a signal for breakdown? It's not to suggest that one is more right than the other. What it is to suggest is that it might alter the way that you get your confirmation signals. So if you're using the 20 and you've been below the 20-day for 4 days, you might have already exceeded your comfort, right? And some of you would have used that as a signal to lighten up positionally. That, unfortunately, that would not have been right in this first oval. Now, the second oval, you didn't really close below it, right? We closed at it, and then the very next day with a big, beautiful candle, we were right back above it. But back here, just a week and a half ago, we also were below for about 3 or 4 days. And so if you're the trader who is looking for confirmation in the sense of 3 days, 4 days below the supporting moving average to validate a potential breakdown, well, then these closes below the 20 could have been giving you those types of signals. And if you don't want those types of signals, then we may need to make an adjustment to the moving average, is ultimately what we're saying. Doesn't mean one's more right than another, but it might make your job as manager of trend analysis for your own individual positions a little more easy if we're using the moving average that seems to be most respected by the instrument we're watching, in this case, the equal weight. All right. So that was a lot of discussion. I hope that was helpful, at least as it relates to what's going on with the S&P 500. Remember the cap weighted version versus the equal weighted version, and why we're seeing equal weight in the strong trend, while at the same time we're witnessing the cap weighted version in consolidation, digesting the negativity associated with technology of late. Now, speaking of tech, let's go back and check out the NDX, the NASDAQ 100. Obviously, we know the heavy allocation to tech here. We are in amidst still of a bit of a drawdown. We should not at all be surprised by the bounce back that we got over the last three sessions. And further, we probably should not be surprised by the level to which we bounced back and have taken a breather. Now, we don't yet know if this is a legitimate breather or potential resistance in the rectangle I've drawn in, but it certainly was supportive of our trend right here, right? Support, and then support, and then suddenly it wasn't support and we were below it, right? And we broke down pretty well. In fact, if we looked at the day that we failed here to the low we made just last week, yeah, we sold down about 4.5, almost 5% there. And now we have managed to rally ourselves right back into it. So, common viewpoint here, as usual, everybody. What once was support can act as resistance, and that may be what we're witnessing now. So, what are we looking for? We're looking for a shift to what has been going on. Hopefully, we can get ourselves outside of that 20-day moving average. We want to get back above it. Notice how we have basically been below the 20-day right about since here. Yeah, this was June 23, mind you. We were above it for all of a day and 2 days. But essentially, these were not giving us any confirmation of our breakup through the 20-day to the upside. So, kind of looking at the 20 as a very important area for the short-term view on the NASDAQ 100. So, lots to pay attention to on the NDX. Now, at this time, I would like to bring to the table a good friend of mine, Mr. Jeffrey Abelos, joining us today. Jeffrey, it's great to see you, buddy. How are you?
That's great. Really great to be here. I do apologize for my delay, everybody. Kevin, thank you very much for having me on the show. Wanted to get in a little bit more research, of course, before I hopped on, but looking forward to our discussion. Also wanted to note as I was watching the first part of this segment, August historically is a weak month, everyone. So watch out for that. The first 9 days especially can be pretty troublesome on the S&P 500. But Kevin, really glad to be here with you today. Thanks so much for having me.
Hey, we're glad to have you, Jeff. Obviously, love having the opportunity to speak with you, get a little back and forth going here. I'm sure you heard a little bit about what I was saying as it relates to the NDX and what we're watching with technology being a little bit under pressure here. Is there anything that you want to make sure you touch on as it relates to tech and NASDAQ specific, perhaps?
Well, I think for a lot of traders and investors, especially out there, the breadth rotation is probably a good thing where we're seeing other pockets of the economy starting to do a little bit more of the lifting as opposed to just the information technology and more the communication services sectors that's heavily weighted in the NASDAQ.
Hmm.
But that being said, I would say that without having a little bit of help from the NASDAQ and those big tech companies, the market is probably going to have a hard time hitting an all-time high over these next few months, Kevin. So
Hmm.
without seeing some major movements, especially like you noted above that 20-period simple moving average, I just don't know how this earnings season gives enough inflation to the data that starts to say, hey, this thing is going higher and higher and higher. We are going to start hitting new all-time highs. This could be one of those sideways markets that we see possibly in and through the midterms, Kevin.
Yeah, it's certainly a possibility. I mean, we are witnessing more pressure on semis today. We're going to look at semis here in just a minute, but you're right. Technology unwind has been maybe a little more stout, and I know that it's not uncommon to take bigger moves like we got last week and move to the downside only to watch things bounce back quickly. But it really hasn't been a bounce back to new trend just yet. And I think that's what's notable about the NDX is our time frame below the 20-day. When we get again, we had a couple of days, right? 1 day, 2 day, and when we're back below it, one day, 2 day back below it. These are exactly reasons why, Jeff, confirmation for so many traders is important.
Yeah.
And yeah, we've gotten a bounce, but as I was pointing out, fair bit of resistance overhead. Maybe the 20-day will shift that viewpoint a little bit, but obviously a bit heavy on technology at the moment. Why don't we talk
Yeah.
about small caps here?
Sure.
Small caps are at that interesting spot. We had a bit of a breakdown. And Jeff, I was just talking about how applying the proper moving average can be very important. It's not important for necessarily trend management as much as it is for trade management. When we're below a moving average that we like, we respect, then we tend to use it as decision making. And so when I look at what's gone on here over the last, say, week, we've been dabbling below the 50, but trying to stay above it. So, Jeff, what are your takeaways as it relates to what we've seen here?
Well, really great call out. You're right. It seems to be we're at a bit of an inflection point. Everybody kind of notices this too. Uh-oh, 20-day, 50-day, these are coming together. We've got the index right between the two of them at this very moment. Here's what I
Hmm.
would say. This is one of those times where you may not want to try to jump ahead of the trade, but if this cannot hold that 50 period simple moving average, Kevin, give it 1 or 2 days closing below that. I would imagine this is where people start to say, you know what, I think I'm off of the small cap bandwagon. And you start to see people taking the elevator down as opposed to the stairs.
Okay, so big spot then, essentially, because
Mhm.
as I drew in, we still have a downtrend, short term,
Yeah.
albeit. And the other thing is that we've got a input detail here for Russell that we can't get away from, and that has been the recent explosion in the 10-year yield as an
Yeah.
example of just consistent and ongoing pressure. Now, recently, Jeff, the Russell's digested all of that bullishly somehow,
Yeah.
but this thing just keeps climbing. And as we continue to be relatively, I would say concerned, but at least aware that the FOMC is potentially going to raise rates in the future on the Fed funds rate, all of this could provide headwinds for the market.
You're right. Yeah, I think the last I checked, the Fed tool is at about a 60% interest rate raise coming in
Hmm.
September. But we've talked about this for the last few months. Interest rates are going higher, small caps are falling along. That doesn't make any sense. And I've mentioned it a number of times. I couldn't figure out why exactly this was happening, and I still can't, but it's starting to act more normal now. And for the viewers out there that haven't caught this yet, when you see yields rise, that means interest rates are going up. That tends to be detrimental for the small caps because their businesses are so heavily dependent on the fixed income space. They have to borrow
Hmm.
to get the things they need to sell for their end users. So, yeah, really good call out, Kevin. This is starting to look a little bit more normal in what most of us as market participants come to expect. As the interest rates are going up, small caps take the beating, and that's what's playing out now here on the charts.
It really is. So if you're that small cap trader, that Russell 2000 holder, what we're looking for here is at least some semblance of confirmation that the 50-day support test has been maintained. And maybe the lines can be helpful for us. Closes under that 2,900 would be significant. That would be a greater likelihood of a deeper pullback for bulls. So you'd have to be attentive to that. But a break over the downtrend line, we would invert that viewpoint and say that a greater likelihood of higher highs is on deck. So we're looking for a close over the downtrending white line or under the horizontal recent support. Both of those would tell us, or I should say, either one of those maneuvers on a closing basis would give a trader a lean one way or the other. And that's all we're looking for. We know one thing, it doesn't guarantee any move, that's for sure, but it would give us a lean, we could say.
Really
Now,
well said.
Jeff, let's look in on our semis and then we will move over and see what's going on with oil. Semiconductors remain under pressure. Jeff, much of what I said as it relates to the trend in the NASDAQ 100 could likely be applied to what we're seeing in the SOX here as well.
Yeah, you're absolutely right. You had the 20 crossing below the 50 period. You've had it, it hasn't even really tried to test that 20 period. Look at that space between the 20 and all of those
Hmm.
candle tops. That's just almost like an exhaustion that you're seeing from the market as it relates to these semis right here, Kevin. The next question is, all right, so what do we do from here? I don't know that there are a whole lot of folks that are in the bullish camp saying this is a reason to have a bottom. I haven't yet come across that story. I haven't yet come across that feeling. Where is the attention going to be focused? That 10,000 level, probably going to be a psychological spot where you have it lined up here on that bottom of the big red candle. We'll call it late July or so, just a few days ago that it
Yep.
bottomed out there. Yeah. After that, though, I think a lot of eyes and attention is going to be paid to that 200 period simple moving average. Maybe you get a little bit of a test at the 10,000 level just for the psychology of the markets. But after that, people are going to say, well, I really don't see a reason historically why we should stop too long where we are at this 10,000 point. Boom, that goes down to that 200 period simple moving average if we can't hold it.
Unfortunately, I have to agree. I mean, if we're
Mhm.
just a trend trader, that's the way to look at this, unfortunately. Below the 20-day now since basically right here, so July 1. And yeah, since July, the move here has not been terribly great. In fact, if I applied my details with labels, we'll see that on a this month alone, obviously, we're down 3%. But the month of July, if we would have looked at this, it would have been pretty ugly, unfortunately, here. Where's our close on the 30th? Our close was at 14,246 approximately. So if I was to draw that line and then take it to basically the close here on Friday of last week, which was 11,311 or so, then we basically had a month where we dropped 20% in the stocks, Jeff.
Yeah.
That's not a great look to get a 20% drawdown in a single month. But,
Yeah.
the reminder should be that we had an immense move to the upside, from our April or March lows to our peak there in mid-June was 100+%. So let's do a Fibonacci just to give everybody, make sure we apply equal time to all concepts. So
There we
there's
go.
your Fibonacci move, Jeff, that 50% level kind of standing out. We're banded between it below here. Maybe we hold up to the 50 ledge from a support standpoint over the coming couple of days here. That would be a positive development if it could hold.
Yeah, you're absolutely right. I want to shout out to a comment that I'm looking at here. One of the viewers says, at mental saturation on my open positions can only focus on a limited number of stocks. I'm talking
Mm.
to a lot of folks in our branches around Southern California. We're seeing this with all of them. Oh, this strategy isn't working out. What should I do? This used to be something that worked out really well, and now I just don't know what to do. When times like that start to come about, and you see this in a lot of the charting, think of a triple top, double top. Think of a reverse head and shoulders. The exhaustion point seems to be more violent because everybody says, hey, this isn't working anymore. I'm just going to get out of almost everything. And so that's
Hmm.
where I think you see a lot of this big down movement coming in the stocks here this morning, Kevin, is because everybody is just exhausted. This trade worked out so well. Now I'm down 20%. I just don't know about that. This correction is probably not for me. I think I'm going to start to liquidate and look for other opportunities in the market. So really good call out to that, but also speaks to the psychology of the market. As people get exhausted, those down movements become much more pronounced.
Yeah, they do. That's a good reminder. And that volatility is going to lead into that as well, right? When
Yes.
volatility moves and spikes, as we've seen a little bit of late, that volatility will play into some of the maneuvers we get. A big sell-off leads to a big rebound, but it doesn't necessarily change the trend. That's kind of
Mhm.
what you saw here in the stocks over the last 3 days from that low to the high we made on Friday was a great bounce, but it did not change trend. And so often it's important to, as you all know, drill into those shorter term windows, utilizing shorter term periods. I like 1 hour bars, sometimes 4 hour bars as well, and use those to your benefit. You can kind of zoom into a window of time that can be instructive about the potential for that move changing. We often lead into the daily chart, but if you're trying to be a little more fine, Jeff, there's nothing wrong with zooming into a tighter window and using tighter bars.
Yeah, you're absolutely right. That's why I love the fractal nature of the market. You can
Hmm.
use these concepts across multiple time frames. Good call out.
Absolutely true. Jeff, we had
Yeah.
one of the reasons I think we're seeing a little bit of the market pop this morning is probably tied to oil. So let's look at oil And we'll talk a little bit about that. We're going to use the futures symbol as we do in this class, but we're not advocating for futures trading per se. It does carry a higher level of risk. It is available for you traders here at Schwab. Make sure you go through the needed steps to be approved to trade futures if that's of your interest. But we're doing so as a means of understanding trend. We're going to look at the crude future symbols here, Jeff. I've got the downtrend pretty evident here still, whether I start at the ultimate peak or maybe just the approximate peak, but that stands out to me. So we haven't broken the downtrend that we've been witnessing off of the peak, and yet the movement here is still very important to us as a drawdown today. You know, we're looking at 7% pulling back on that headline that the U.S. pulled back from attacking Iran further. Well, that's being taken favorably here today, obviously.
Yeah, very news driven part of the market. So this one's one of the more difficult, I think, to trade because at any moment a tweet or do they even call it that now, Kevin? I know it's referred to as X. I don't know what the names are. Apologies, I'm not in social media. But somebody saying something that gets to the masses can very quickly change the trajectory of oil. That can be very, very detrimental for a trader's portfolio who is heavily in something like an energy space. Think of it this way. If I have a portfolio and I've only got one company or two companies in it, and somebody saying something about those one or two companies can either make or break my day, I may have some pretty bad days in there. And I think that makes it very difficult to get a read on something like the oil market right now, Kevin. But what I
Yeah.
do like is this call out. Notice that despite all of this very news driven headline risk, you still have the tenets of charting following through. Those
Hmm.
connecting lower highs still shows that downward trending movement. Now, the fact that we are coming into the space of the 20 next to the 50 next to the 200, and the oil market right in between all of those, that could mean something. But again, this is going to be very much news headline driven. So be careful out there. If you're trading oil, try your best not to try to get ahead of the trade. Wait until something happens and then follow the momentum.
And Jeff, it's not just crude that we're watching here. Yes,
Yeah.
crude is our biggest area here, right? But we can also drill in a little bit and see how this is impacting the other areas of the economy. And one of those, of course, is going to be gasoline prices. And you'll notice that, Jeff, gasoline prices are actually dropping today nicely as well. This is a boon for us in the sense that obviously lower prices at the pump is going to be disinflationary, but I'm going to throw a cold blanket on that in a moment. I wanted to hear what you thought about the RBOB look here real briefly.
I do like that gas prices are lower. I actually just drove to and back from Arizona to California this weekend. So I got to experience this firsthand. But I was also reading, Kevin, that airlines, despite gasoline coming a little bit lower, they are keeping their prices elevated. Why?
Yeah.
Because consumers are still continuing to pay that, which may be a positive thing for the airline space. And we may talk about that at some point. But having that ability to look two or three chess moves ahead and say, okay, if gasoline prices come down and airlines say they're going to keep their prices higher, and the K-shaped economy keeps those more well-heeled clients in the airline seats, that could be good for the airline space. So I really like this call out, Kevin, but it's also about seeing what could happen two chess, three chess moves ahead.
Yeah, it's true. But here's the wet blanket I wanted to throw on
Let's
that
do it.
for you,
Let's
Jeff.
toss it
So
right out there, big guy.
we've got gasoline futures going lower, but if we look at heating oil futures, which can be considered a potential proxy for diesel, well,
Ooh,
this stands out because now, granted, again, a good move today for us from the standpoint of disinflationary, Jeff, but notice the trend difference here. Broken down trend, working a new uptrend. Yes, we're below the short-term 20-day moving average, but the 20 crossing the 50 to the upside. This is a different pattern, and the concern here for me is that elevated diesel prices leads to inflation. Again,
yeah,
now,
yeah.
again, we can talk about that in a number of levels, right? If you talk about it from crude standpoint, that's one thing. But you have crude that gets refined into retail gasoline versus diesel gas. And we know diesel is used most commonly for semi trucks and
Mhm.
carriage across country, of course. So,
Yep.
Jeff, if we're moving product, great. But if we're moving product with diesel that is elevated, then that is inflationary.
Yeah, you're absolutely right. And this is probably why you're seeing a lot of traders out there saying that most likely there is one, potentially two more rate hikes baked into the Fed outlook coming for the rest of the year, Kevin. Really good call out, my friend.
Yeah, all of this comes together a little bit, doesn't it?
Yeah.
Now, it doesn't make it any easier
No.
to decide what the heck I'm going to do with my positions, but it at least gives us a better understanding, perhaps, of why we are seeing what we are seeing. And you mentioned airlines, so I figured let's just go ahead and look at the airline stocks rallying today on a 7% drawdown in crude. Should not be surprised by that, Jeff. And maybe this is a reminder that we traders can build trades around stories as they develop. Today's story might be lower oil, lower cost to airfare, but better, and maybe not lower cost because we're still paying the high
Not for
exorbitant
us,
cost,
yeah.
Jeff, clearly. But that's still a positive for the companies, the airfare, the airline stocks. As you can see, we're getting a rally today, and that looks like a pretty significant gap level achieved today, perhaps.
Yeah. Yeah. If you want an example of this for the viewers out there, you can do your own homework, but go back to grocery stores, go back to companies like Nabisco and so forth that were selling post-COVID. They inflated prices really, really quickly. Hey, we got to watch out here. Let's make up for this. As prices on their core goods, think of wheat and eggs and so forth, started to come back down. Maybe not eggs, if everybody remembers that incident. But when all that started coming back down, they looked around and said, well, wait a second. We haven't been carrying the best profit margins for a long time now. This might be our moment. And so you had people in the government and folks starting to get a lot of clamorous about, wait a second, prices should be coming down. Why are you guys keeping them elevated? Then you would listening into their earnings call and they would say, well, consumers aren't really going somewhere else and we're making pretty good profits. So I think we're going to keep it here as the people who have some of the most to lose and gain from our stock price. So I would not be surprised to see the same thing play out possibly for the rest of the summer, even into 2027 from what the airlines are saying as it relates to their profit margins, Kevin.
Good stuff, Jeff. Let's also give the people the reminder that in the industrial space, it's not just air stocks, but let's hit up the truckers real quick. They're getting a little bit of a hold here. You know, we had a wonderful uptrend working, and they, as we saw, diesel breaking higher, those broke lower, so a little bit of a pullback. Maybe if diesel is going to pull lower, you're going to see a little bit of a bounce here. We'll monitor that. And then, of course, the rail stocks is also important to check on. These, of course, are the three legs of that transportation index, and rail stocks have pulled back to the 20-day simple moving average. So a potential zone of support for those if you're looking for opportunity in the rail space. Now, Jeff, let's talk about some of the sector moves here. We've been talking energy to an extent through the use of oil. So let's look at the energy sector. Jeff, again, I think what's important is the most recent action, while it hasn't exploded to the upside, it's not come back below that downtrend line.
Yeah, very helpful for the energy space, and which is heavily dependent on the oil here. You're absolutely right about that. For the traders that are in a trade like this, a sector energy, there's more than just the oil companies. But notice how Kevin's showing that crossing of the 20 going above the 50. That's short-term positive bullishness right there. You also have the fact that as it's been pulling back, Kevin, it hasn't really come down to find that 20-period simple moving average. Hey, we got a little bit of zone here. We got a little bit of space. So this is some pretty decent coverage and area that says maybe people are more bullish on this than would suggest an exhaustive movement, at least at this point in time, Kevin. That's what I'm seeing. I'm curious, what are your thoughts, though? This is something that you're a little more tuned to.
Very much the same, actually.
Okay.
I think I'm drawing this line in here. This is, very short-term horizontal support. It's more like, would we be at all shocked to get a move like this one here, where you have a weak open one morning on a headline that leads to a rally in energy? No, I wouldn't. Any test of the 20-day would just be confirmatory in nature of the importance of the 20-day, where we've been above it here since July 8. Notice the breakout. And in the 2 days to test and hold the 20, a nice hammer candle at the 20. Every reason to consider the 20 to be support in the short run. But if you're a bull in the very short term, noting the lows here 3 days in a row, all coincident with one another at around that 892 level on this index, this sector index, that is very important short run. But we shouldn't be shocked to get some intraday volatility, something that tests the 20-day. But a break under the 20 would be a shift. That'd be something different than we've seen over the last 3 weeks. And again, we're talking about a big move. I mean, this is taking out the downtrend is a significant development. Holding the downtrend for the 2 weeks after the breakout is equally significant in many cases, Jeff.
Yeah, good call out.
All right, moving on. Let's see how we're looking in our industrials. This chart's going to continue to look bullish to me, Jeff. I can't get away from that.
Okay.
We've been above the breakout spot basically for the entirety of it. So go back to mid-June. Now you're looking at about 6 weeks here of holding the breakout level, that 50-day moving average nicely, gently upward sloping.
Yeah, I'd go more neutral. So this is a good divergence
Okay.
that you and I have. As I'm looking at this, you've got the longer term higher highs. So longer term, let's call it a year or so, if that's your time horizon, you're probably in the more bullish camp. I'm zoomed in a little bit more for the last, let's call it month to 2 months. I'm seeing, yeah, that little wedge pattern start to form
Yeah.
right there, in addition to a almost like a sideways movement that you have here. But that moment where the wedge starts to come together, traders, watch out for this. There could be a potential break to the upside where the market says, okay, this is the time that we want to see the industrial sector break out and start a big bullish movement. That could also be a time where it says, hey, another story has taken hold during these last couple of weeks. We're going to start dropping down and take our profits off the table. This is a little bit too worrisome. So this is one of those times, Kevin, where hard for me to say I can go to the bullish camp. I am curious, though, is there something that you're looking out on the horizon that says there's a moment in time that the industrials could have that crisis point that either we go bullish or we go bearish or nothing happens at all?
Well, I'm going to say this. I mean, this
Yeah.
candle here from Thursday looks
Yeah.
very significant to me.
Okay.
And I
Tell me
say
why.
that because look at the size of that tail. It looks like we had an absolute breakdown. In fact, look at the gap. We basically filled the gap for a test,
Okay.
and
Yep.
then that was held. And so, as always, not every gap needs to be filled, but in this instance, we got down there early in this day on Thursday, held that, defended exceptionally well by the bulls, so well that you got 2 continuation days thereafter. Now, we haven't broken trend, so we're still, as you stated, in consolidation. It's most likely that the narrative related to AI needs to come back to the forefront for
Ah,
industrials to break out, I would say, because the
okay.
reason, in all likelihood, that we've seen industrials going this manner, Jeff, is because of the massive physical build out of the data centers necessary, right? And
Yeah.
at least that's the way that I've been reading it. Doesn't mean it's the way that it is or that that's right, but that's how I see this. And so if that AI trade returns to prominence and we are once more buying up everything relative to AI, well, the chances are it's going to be important that industrials provides some of that leadership, reminding us that we are actually physically building data centers.
Gotcha. Okay, so it could be this earnings season. It could be the earnings call. It could be the conference discussions after the earnings are announced. That could be our catalyst, whether we go more bullish or we become more bearish, at least on the
Sure,
industrial side, possibly in some other cases where we've got that wedge pattern forming. Okay, gotcha.
possibly.
Really, really helpful.
Yeah. All right. Moving on down our list. We just want to touch on a number of these. There's your discretionary move. My goodness, Jeff, this has
Wow.
been really great over the last just 3 sessions here. What a pop to the upside, huh?
Holy smokes. Look at that. Just
That's a
jumped right
significant
up.
pop.
Yeah, yeah. So let's ask it this here as commentators of what the market is doing. Are we thinking that this just pumps right past the 2000 level, or is this the pole of a future flag or pennant formation? What are the thoughts on this movement here?
Boy, the pattern is a long range developing pattern, isn't it, Jeff? I mean, this is
Yeah,
the
yeah.
weekly look here. Long term uptrend from last April. Higher lows in here. This is the 100-week moving average we're bouncing off. And I'd say that we could draw a pretty wide range at the upper level that we have to pop through.
Okay.
There's clear resistance up here, but it does have the makeup of an ascending triangle, albeit a very wide one.
Hmm.
That's kind of interesting. And again, I'm still kind of dubious about it. I want to see when we look at the visualize, maybe we can get a little clarity about what might be moving it. Let's see here. There you go. So,
There you
well,
go.
okay. I think we have our answer.
Yeah.
So, Amazon, Amazon has moved exceptionally in the last week. So, let's do this. So, first of all, make note of the size of the Amazon box, everybody. Remember, cap weighted viewpoint, Amazon's movement and Tesla's movement are carrying substantial weight relative to what's happening in discretionary. So let's put on the Amazon chart, Jeff. And this is
Okay.
as good a time as any to, let
Wow.
me go to my draw tool here. All right, I'm going to clear this out. Just clear drawing set. There we go. So Jeff, Amazon's made the biggest of the moves following earnings here. In fact, I had an analyst note on Amazon today. They had a price target adjustment, not an upgrade, but a price target adjustment, I think is what I saw. So let me find that. But
Okay.
Jeff, talk to us about this move because this is pretty ridiculous here. I mean, that is
That's
a substantial pop.
You certainly don't see that every day, Kevin. Some of the things to note for the viewers out there, you've got the jump above your previous high. Now, notice, as I mentioned before during the show, you had that double top and then that exhaustion where it took the elevator as opposed to the stairs down.
Wow.
So keep that in mind. Now that you've gotten above it, couple things to know. One, just getting above it is not enough. Just getting an A is not enough, everybody. You have to keep that A through the rest of the semester. So
Mm-hmm.
what could be a bullish case? Well, you've got those big green candles. That's helpful. You also have that volume. It's a little bit small down there, but you notice the volume is increasing. Ideally, as a trader, what you'd want to see today is the volume continuing to go past the previous 2 days. So beat out Friday, beat out Thursday. What I would be careful of, everybody, this could be a very quick reaction and a very violent move to the top side that is short-lived. I certainly hope it's not. You do want to see people continuing to spend, and that'll help drive the economy. But this might be a time where folks get a little too ahead of their skis and they say, gosh, I've made a heck of a lot of money in a very short period of time holding on to Amazon. I just don't want to lose that. That FOMO starts to creep in and you see some taking of profits, starts to pull back a little bit. That could be where that flag starts to form, Kevin. And ultimately where the market goes from here is anybody's guess. But those are some of the things that I'm catching. What are some of the things on your mind?
A lot of the same. I do
Okay.
want to share the headline that we have this morning. So Roth Capital raised the target on Amazon to 325 from 300. That's still, a nice premium. No guarantee that it gets there, of course, but they maintain a buy rating on the stock after the 15% pop that we got real late last week. The firm believes that Amazon is demonstrating the highest AI return on invested capital versus their peers. So
Wow.
this is essentially a peer story, I guess, is the way to look at it. By the way,
Intriguing.
I'm going to
Yeah.
put on a Fibonacci on this at the request of somebody. That was Nathan that asked for a Fibonacci on Amazon. But I also saw earlier there was a survey opportunity in the chat, everybody, and just love to hear from you as always. Whenever we get a survey opportunity, your input is valuable to us. Would love to hear from you. It takes all of 60 seconds. You can give a score, you can leave comments. All of that comes to Jeff and me directly. So if you want to take a moment, we would greatly appreciate it. Jeff, I'm going to back us out to the weekly,
Okay.
show the highlighted levels here. A couple of things. One, the 100-week simple moving average clearly providing some support along here, Jeff. And
Yeah.
the takeaway might be that the reminder that while we do get pullbacks to the 100-week, notice, Jeff, we didn't make lower lows in those weeks. We made
Right.
matching lows, we made similar lows, and we moved off of it. Now, the Fibonacci request, commonly we just take the extended levels, the highest high to the lowest low, and then we get an idea of where the extension can take us. And so that target is approximately that 310, 311 zone up above. Never are these a guarantee to be achieved, but that's one way a trader, Jeff, might set that target and start eyeballing 300. And maybe, Jeff, they're going to start
Yeah.
layering some exits. Maybe some portion of the trade at 300, another portion at 310, another portion a little higher. Having those limitations set and automated can be really helpful to the trader.
Yeah, absolutely. A little bit of measured movement in there as well, I noticed, going from the low of the movement to the high, and then you just take that and then stick it right back up. Okay, so overall, some bullishness looking candles and some movements that could be of note on the Fibonacci's. Really good call outs, Kevin.
Yeah, always good to do a little draw fib. Drawing Fibonacci's is fun stuff. I mean, drawing
That's
all those
right.
lines is fun stuff. Everybody knows that. We love it. We're right about at time, everybody. I know we didn't get through all of our details. Let me just highlight this for you. As I'm working down the sector move, notice how Staples is just continuing sideways. Healthcare holding on to the 20-day. Now we got pushed back pretty quickly, Jeff, to the 20, but that could be supportive. The move in financials continues to be stout. The 20-day here has been wonderful since the break of that downtrend line here. So we've been watching this one for a while, really since the break of the downtrend off of this, when we consolidated for about 2 months. But boy, the strength in financials here cannot be denied at this moment.
Yeah.
We'll see if that changes at some point, but continues to look strong. And then there's your technology. We're waiting for the breakout, Jeff, but we're still dabbled well below the 20-day. Last note there. Look at how we just 3 days in a row, right to
Yeah,
the 20
right
as
to the 20.
resistance. We just can't get through it, Jeff.
It's trying its best. It's the little engine that may be.
Great way to put that. The little engine that may be. And
Yeah,
with that, let's leave our viewers with a smile today, man. How about that,
sounds
Jeff?
good. I love it.
Glad you made it today. Thanks for being
Thanks,
here.
man.
Thanks for sharing your thoughts, your insights. Where are you going to be this week?
Always a pleasure. I'm going to be in La Jolla come Thursday. Wednesday, I'll probably spend some time in San Diego, and then on Friday, I might be in Rancho Bernardo or Carlsbad. So if you're in and around those areas, reach out to your financial consultant, see if we can get a meeting together.
That sounds like a great idea for those of you in the area. And for the rest, hey, come see us at one of the events. Next up is Orlando this weekend. I will be here working the channel rather than the Orlando event. But beyond that, we'll be in New York City end of the month. So check us out and come visit for an in-person event. Thanks to Connie in the chat. Don't forget that survey, everybody. And if you liked our discussion, the thumbs up down below will help us out on the replay, which will happen here shortly after completion. So with that, have a great rest of your Monday. Cryptocurrency Basics is the next class at 11 a.m. Eastern with Ben Watson. I look forward to catching up with you all again real soon.